So just some random deadlines within 5 days. Written approval or reason for denial of request for pre-authorization of non-emergency medical services. You cannot require pre-authorization for emergency services. I hope everyone can understand why that is part of the rules. And then 30 days, so after initial notice that the insurer is contesting a claim under disability policy, must affirm or deny the claim or notify the claimant that the insurer needs additional time and information. Next slide. Settlement criteria, there are 6 objective factors that is kind of considered if the CDI is going to be looking at a settlement between a claimant and the insurer. Those are, extent to which the insurer kind of considered evidence submitted by the claimant. Did the insurer consider other reasonably available evidence or legal authority? So what else was considered beyond what was received by the claimant? The extent to which the insurer considered advice of a claims adjuster about the appropriate amount. Did the insurer consider advice of its claims counsel that there was a substantial likelihood of recovery in excess of policy limits? The extent to which the insurer considered probable liability of insured and likely jury verdict, and then procedures used in determining the dollar amount or property value. And again, another place to kind of paper the file when settlements of claims are happening, things are occurring, all the reasoning behind it, all the calculations and other analysis that went into it, you'll want to have in the claims file so that if the CDI is looking at these objective factors, that is all in the claims file and can be seen and determined. And then, because on the same topic, I'll wrap this one up. But there's also subjective factors, which is never helpful because that is CDI specific. What are they going to think about it? But what other credible evidence presented to the commissioner that demonstrates that any amount offered to a first party claimant or the final amount offered to a first party claimant or the final amount offered to settle a third party claim is below what a reasonable person with knowledge of facts and circumstances would have offered in settlement. So the reasonable person standard is always subjective and can really vary by any number of things. So it's not very helpful here. You want to make sure that the objective factors are well documented and contained in the claims file so that the commissioners are looking at this, they can see all that went into it. And hopefully any reasonable person standard they apply, it takes into account all those objective factors.
And then we'll jump back to me for a bit. So in terms of the settlement procedures themselves, what are the requirements? So first of all, as we alluded to earlier, insurers are required to advise first party claimants of additional coverage that they may have either under the same policy or another policy. So I should say additional coverage and additional benefits. So just because they may have submitted a claim under one part of a policy where there is no coverage, if there's a possibility of coverage elsewhere, you need to point that out. There is no deadline on the execution of a release, but you may advise of a statute of limitations, of course. Also, for a waiver of unknown claims, as we mentioned earlier, the waiver has no, it's not a valid waiver unless the legal effect is explained in writing. We've got here in brackets, if not represented by counsel. I think that's a good practice regardless. And so finally, there's also no polygraph. You cannot require a polygraph unless it's authorized both in the policy and by law. And you cannot seek information from a claimant that is not reasonably required for or material to the resolution of the claim, and use just one proof of claim for multiple policies if a second one would be duplicative. You don't want to just keep, make it look like you're overloading the claimants with paperwork when you could have just used the first proof of claim. There also can be no denial of a claim based only on a telephone or personal interview unless it is documented in writing in the file. A good practice on that is always to follow up with a written letter if you do have a phone call, and make sure that that's documented contemporaneously in writing to the claimant. Also, no recovery or set off of excessive or unnecessary medical benefits, except for proven false or fraudulent claims, of course. Medical examinations can only be required based on a good faith belief that such an examination is reasonably necessary to determine whether the claim is covered. We can't make people, of course, undergo medical examinations without a good reason. It has to be good faith. No settlement can be contingent on the status of a complaint with the department. So you can't say, okay, I'll settle this claim for you if you promise not to file that complaint with the CDI, or if you promise to withdraw your complaint from the CDI, then I'll pay your claim. You can't do that, which is interesting because I'm sure such conversations sometimes take place. So I think maybe in other states, not California, is what they're saying. Also, you can have subrogation only where appropriate, and you must notify a first party claimant if there is a deductible. Oh, I went too far. There we go. Subrogation demands must include a first party claimant's deductible and must share the recovery proportionately if the claimant has not recovered its full deductible. This does not apply to disability and health policies. You can have no so-called black box defense, meaning that the insurer is fully responsible for information, data, or statistical methods used by third parties. And that's an interesting one now, of course, given that people are increasingly starting to look at ways to use AI. Regulators in the US, of course, are increasingly interested in how insurers and other industry participants are using AI either for underwriting or for claims, and how are you using AI that might affect the outcome of a claim? We're seeing some, at least draft regulations or legislation promulgated seeking this kind of, that would purport to seek this kind of information from insurers and other regulated entities. And so again, that's important to keep that in mind too, that you can't kind of say, oh, I use this modeling data, or I used some AI to determine what was the right amount to pay here. The regulators want you to have full responsibility for that. You also must consider any evidence or documentation that provides any evidence of the claim and that reasonably supports the magnitude of the loss. So if the insured disagrees with what you've offered, then you have to say to them, okay, I'll consider, do you have a different estimate? Show me, and you have to be reasonable in considering their alternative evidence there that might support the quantum that they're claiming. And you must provide notice to individual third-party claimants if a settlement is paid to an agent or a representative. So you still need to tell the claimant directly, and then that way, if they follow up, or make a complaint to the regulator, it's not appropriate to say, oh yeah, the check's in the mail. You were supposed to tell the third-party claimant that you were paying their agent or legal representative. Also, of course, there can be no discrimination in handling claims. In California, they have enumerated 11 suspect categories, which from the Unfair Trade Practices Act, which is the standard ones: age, race, religion, gender, sexual orientation, ancestry, national origin, language, physical disability. Two less obvious ones include income or territory. So you cannot discriminate on the basis of any of these factors. And you're required to conduct and diligently pursue a thorough, fair, and objective investigation and not request any unnecessary information. And then when it comes to payment or denial of claims, the timing for payment is that you must tender payment within 30 days of either affirming coverage of all or part of a first party undisputed amount and execution of properly executed release when necessary. For denial, if you're rejecting the claim, that must be done in writing, including the basis for denial. And the factual and legal basis for denial must include references to the specific policy provisions, exclusions, or conditions that are relied upon, and an explanation of how those provisions apply to the specific claim at hand. So that it's important to, again, as Alex was reiterating, to just full disclosure and give as much information as possible. Make sure that the insured has as much information, or the claimant has as much information as possible about why you're not paying their claim based on the policy wording or other factors. And finally, it's also important when you're denying a claim, if whether in whole or in part, there's a requirement to provide a notice that if they believe the claim to be wrongfully denied, they can complain to the insurance department, and to provide these details where they can contact the department with their complaint. Excuse me. And we just sort of put up this flow chart here that, well, maybe somewhat handy, maybe not. I don't know. Some people might like to think pictorially. Some people might find this more confusing, but just to sort of outline the different deadlines to keep in mind with respect to the timing of key actions here, and the different statutory references that we mentioned earlier. So for example, you see here, immediately and then within 40 days, if fraud is suspected, within 40 days or 80 days if fraud is suspected, you either accept all or part of the claim, which probably don't accept all of it if there's fraud suspected, but we request more time to determine all or part of the claim, describe any reasons why, and any additional information needed. If you're denying the claim in writing, if it's a first party surety claim, state the entire factual basis and cite to the policy. For all other claims, all claims, then you have to state the claimant can contact the Department of Insurance, etc. And so this also, takes you down to if you're requesting more time, you have to do that within 30 days. And then after that, if you're requesting more time, then within 30 days, you either make additional requests for more time, or you pay or deny, and then go back up into the cycle and either accept all or part or deny. So just to help with that. Now, this next section of the presentation is going to go over special rules for certain lines of business that are covered in the regulations. And this one is for automobile coverage, which also includes some commercial business, commercial auto. California has very detailed rules about this. So apologies in advance for this. This is going to be a little bit dry, but I will try and get through it quickly. So a cash settlement for actual cash value must include all applicable taxes and one-time fees incident to acquiring ownership, and must include license fees and other annual fees on a pro rata basis, even if a replacement auto is not purchased. If a lost vehicle is retained by the insured or the claimant, then the cash settlement must account for sales tax, salvage value, and fees for making vehicle salvage status. Details of the salvage must be provided upon request. And for a salvage vehicle, you must give written notice of the requirement to notify the Department of Motor Vehicles, and that such Department of Motor Vehicle notice might affect the resale and insured value. If the insurer makes a total loss settlement on a total loss salvage vehicle, then the insurer or its designee must provide a proper notice or fee to the Department of Motor Vehicles within 10 days. There's also a detailed description in the regulations of what constitutes a comparable automobile in terms of making a settlement payment. So, and that's a vehicle of like kind or quality, year, make, mileage, and model restrictions, etc. And there's increasing detail in subsequent amendments to the regulations over the year. So it's important to just make sure that your adjusters are referencing that and coming up with the the settlement. Value adjustments, including for betterment or depreciation, must be discernible, measurable, itemized, and specified with dollar amounts documented. So you can't just say, oh, we've taken off this much for depreciation. You need to explain where that came from. The value must be determined in the claimant's local market area and must have been available within 90 days of the offer. And you must document availability, including the VIN number, stock or order number, or license plate number, if such information is available, as well as the contact details of the seller. But however it's determined, the cost of a comparable automobile must be itemized and explained in writing at the time of the settlement offer. There are also limitations on when a replacement automobile may be offered. Again, continuing with auto, you cannot request that a third party pursue their carrier if the liability and damages for your insured are reasonably clear. You also, in addition, labor expense. So for any labor that's required to repair the vehicle, labor expenses are not subject to betterment or depreciation unless you've specified that in the policy. And importantly, particularly in California, you cannot require that they get their repairs done at a specific repair shop. You can suggest specific repair shops, but you cannot require it, but you can suggest to them if either they ask for it, which sometimes people do, or if they're given specific written notice of their right to choose. So you can say, here's some repair shops that you might like to use, but also you're free to choose any other one of your choice, right? That's fine then. And you also cannot advise a claimant that a vehicle inspection will occur at a date that is later than required by the regulations to respond to whatever stage you are at in the claim. Cannot tell a claimant that the repair shop chosen by the claimant has a record of poor service or poor repair quality or similar statements if that statement is known to be or should reasonably be known to be untrue, deceptive, or misleading, or solely based on whether they participate or don't participate in a labor rate survey. So you have to have actual information that they really do have a record of poor service or poor repair quality. You can, in terms of providing a copy of the estimate to the claimant, that has to be consistent, for a repair that's consistent with accepted trade standards, and try to resolve differences with the claimant regarding the cost of repairs. There are 8 specific limitations on requiring the use of parts other than new original manufacturer's parts, including insurer warranty. There's you cannot require excessive travel for inspections or repairs. So if they're in a population, an urban population of 100,000 or more people, you cannot require the claimants to travel more than 15 miles for inspections or repairs. And in all other areas, you can't require them to travel more than 25 miles. You must exercise any right of inspection within 6 business days of notice of the claim. So that's quite quick. And it's the same deadline applies for re-inspection after a request for a supplemental estimate, if that's been requested. If you request photographs in lieu of an inspection, that must be made within 3 business days of notice of the claim or a request for a supplemental estimate. And if you want to re-inspect the vehicle after photos, then again, the same 6-day rules apply again. You must re-inspect within 6 days of requesting that. You cannot require the insured or a claimant to supply their own repair parts. There's also an auto body repair consumer bill of rights, which must be provided verbatim to every commercial and private passenger insured, including named insureds that are added at renewal in at least 10-point type. You must provide notice that the insurer will reopen a claim file if the first party insured is unable to purchase a comparable automobile for the given settlement amount within 35 days. And you must pay reasonable towing and storage charges and must provide reasonable notice before terminating any storage payments under the policy. Finally, for the standardized auto body repair labor rate survey, this is, I think, really more for the adjusters. So I'm not going to go into detail about these. This is more for the adjusters and the and admitted insurers. But basically, they have to establish a standardized labor rate survey that the commissioner recommends that insurers use as a basis to settle or pay automobile repairs insurance claims. These have to be filed with the department. Again, more on that particular topic. And finally, now onto replacement cost. Special standards apply for the replacement cost property policies. You must replace all items within a damaged area so that all are reasonably uniform. Right, so that means you can't say, well, I'm not going to replace the floor, but I'm just going to replace, you know, your wallpaper or something like that. Everything has to sort of be reasonably uniform. You cannot require, and there are also restrictions on referring the use of repair entities similar to auto. So, for example, if you're requested or notified in writing that the insured can choose someone else, but if they choose a recommended repair, then the insurer essentially becomes the guarantor of the price and quality of that particular company. So if they say, you know, in order to repair my house, who should I use? Then, you know, you need to make clear that you're not requiring them to use anyone, and you don't want to end up being, you know, responsible for guaranteeing the price and quality. The documentation and resolution of estimates, again, similar to auto, you have to pay the difference, give contact details of an available repairer, or adjust the estimate. So that basically the department wants insurers to try and do what they can to, you know, to meet in the middle and come up with a reasonable estimate for repairing damaged property. There's an appraisal process, which is limited by the standard fire policy terms. So insurance code section 2071 contains the standard fire policy form, which all insurers that are insuring the peril of fire must follow in California, including arguably, because it's not expressly excluded, surplus lines insurers. And so the requirement is to provide coverage that is at least as beneficial to the insured as what appears in those policy terms in the standard fire. And one of the things addressed in there is the appraisal process. So you have to make sure that you follow the standard fire policy terms, which, you know, presumably will be in your policies in any event. if an adjustment due to betterment, depreciation, or salvage, if there is an adjustment, I should say, then you must document the justification for each line item of any such adjustment. And again, that needs to be discernible, measurable, itemized, and specific. Can't just come up with a number and not explain where it came from. Fully explain to the claimant in writing. And if you are repairing or replacing with like, kind, and quality, then the measure of the recovery is determined by the cash value of the damaged property. Labor cost is generally not subject to depreciation or betterment adjustments. Again, same as for auto. And then these are the special rules for surety that I mentioned earlier. There can be no discrimination based on the claimant's age, gender, income, religion, language, sexual orientation, ancestry, national origin, or physical disability, or upon the territory of the property or person insured. Interestingly, race is not listed here, but I think that must be an oversight, and would certainly never recommend that anybody ignore that just because it was presumably accidentally left off the list. Denials must specifically be explained in writing, notice, and then provide notice of deadlines to the claimants. The principal's absence, non-cooperation, or denial of liability is not a defense in a surety claim, and you must pay within 15 days of establishing liability, so shorter deadline. And again, there can be no unreasonably low settlement offers, which again, we went over the standards for that earlier. Special rules for life and disability. Of course, insurers in this market cannot write life insurance on a surplus lines basis in California, but disability insurance could include potentially disability income insurance. And also California uses disability basically to mean health insurance. And there are some kinds of health insurance, such as international major medical, that can be written on a surplus lines basis in California. So I'll quickly just go over this. There can be no recouping, overpayment, and underpayment unless it's documented in the file and the insured agrees, or the mistake is caught within 6 months and there are no factual disputes. The explanation of benefits must be provided with any payments. And there's no penalty for failure to comply with pre-certification of benefits with the pre-certification of benefits requirement, unless the penalties are clearly specified in the policy. You have 30 days from the original notice of claim to accept or deny claims, with, again, rolling 30-day extensions if you need more information. And you must approve pre-authorization for non-emergency services immediately, but not more than 5 calendar days. As Alex mentioned earlier, of course, there can be no pre-authorization for emergencies for obvious reasons. Or you cannot require pre-authorization, I should say, for emergencies. And any copy charges incurred at the insurer's request must be reimbursed by the insurer. So if they say, oh, I need a copy of your medical exam, and then the doctor charges for that, then you can't make the insured pay for that. You need to pay for that yourselves. There are 30 days to affirm or deny after contesting claim, after the insured contests a claim. And finally, penalties. So this gets to how the CDI applies these in practice. So again, as with any penalties under the insurance regulations, they are broadly interpreted, and the regulations give the regulators the authority, quite a lot of discretion, I should say, because these kinds of statutes are remedial in nature. So it really gives the regulators the ability to try and tailor penalties to a specific set of facts or circumstances, and have discretion, as you can see here, to decide what constitutes a single act that is a violation. So 5,000 to 10,000 per initial act. And that could be every claim where a particular issue occurred, or however many days late you might be when meeting a particular deadline. Again, they have a bit of or how many times you fail to meet a particular deadline. They have a lot of latitude to decide what is in the acts. And then also if obviously, which I'm sure none of you would ever do, but if the department has already instructed a person, like an insurer or an adjuster, to cease and desist from a particular activity, then the penalties are of course increased up to 65,000 if that warning was ignored. A single act is punishable if an insurer or licensee knowingly committed the act, and that includes actual, implied, or constructive knowledge, meaning they should have known, right? Willful acts can also escalate penalties and simply requires a purpose or willingness to commit the act or make the omission. It does not require any intent to violate the law, injure anyone, or acquire any advantage. Now, in terms of what criteria the regulators will look at in determining whether to apply penalties, they will look at the existence of any extraordinary circumstances, which includes, any extraordinary circumstances that might make it difficult for an insurer or licensee to meet the requirements, such as some of the things, Alex mentioned before, like some sort of a catastrophe that, I don't know, if the adjuster's offices were damaged or destroyed by an earthquake or something, or, we've had situations in Florida where there were hurricanes and, or if somebody's, God forbid, got the main adjuster that was handling the business died, or, something like that. There's the regulator will take into consideration these kinds of factors. Whether there's a good faith and reasonable basis to believe that the claims are fraudulent and they are reported to the department. So you can't just say, oh, I think there was fraud. You have to follow the rules for reporting that if that's the basis. The complexity of the particular claims involved. So if that makes sense, right? If the claim is a little bit more complex, then it might have made it a little bit more difficult to try and meet the deadlines. If there was gross exaggeration on the part of the claimant of the value of the property or the severity of the injury or the amount of damages incurred, substantial mischaracterization of the circumstances surrounding the loss or the alleged default of the principal, secreting of property which has been claimed as lost or destroyed, the relative number, and so I should say these past few, obviously, they're the regulators taking into account the fact that of potential, bad behavior on the part of the claimant, making it more difficult to try and cooperate and reach a reasonable resolution if they're behaving in this manner. The relative number of claims where the acts are found to exist, the total number of claims handled by the licensee, and the total number of claims reviewed by the department. So have they reviewed lots of other claims or lots of other complaints relating to this particular insurer and found in general to be good practices, and that this is a one-off that would lead to potentially a smaller fine or lead them to not fine on that one instance. That's again a factor. Whether the licensee has taken any remedial measures to try and ensure that the particular violation doesn't occur again. The existence or non-existence of any previous violations, the degree of harm occasioned by the non-compliance. So suppose you fail to meet a particular deadline, but actually there was no harm to the insured as a result, and then maybe the regulator might not fine, particularly if it's a first violation. Whether under the totality of circumstances, the licensee made a good faith attempt to comply with the regulation. So again, inadvertent violations as opposed to intentional. The frequency of occurrence and or severity of the detriment. Whether the licensee's management was aware of the facts that apprised or should have apprised the licensee of the acts, and the licensee failed to take any remedial measures. So if a claims adjuster employs someone who they know or should have known is really just not doing a good job with their estimates, not completing things on time, not responding to insureds on time, whatever the particular violation is. You know, if they were aware of that or should have been aware of that and failed to do anything about it, then, you know, that would be on the company. And the licensee's reasonable mistakes or opinions as to the valuation of property losses or damages. And with that, we bring you to the end of our fascinating presentation. Slightly earlier than 90 minutes, thankfully. But we are happy to answer any questions if you have any at all, whether in the Q&A, I think.
Thank you, Andrea, and thank you, Alex. I know it's a serious amount of content to get through, to of course allow everyone to achieve their certification. So thank you for working through all of that for us. And of course, the slides continue to be really helpful resource material for us. I can't see that any questions have come through. So if anybody is there with a question now, then I'd encourage you to place it into the Q&A. And I'm sure that more often than not, the specific questions arise in respect of specific cases and are passed on to you both. Just one very brief point from my side. So, Andrea, you mentioned the additional focus from regulators at the moment. Is that something that you foresee being maintained, you know, or is this just a short-term, increase in activity off of the back of the wildfires that you mentioned?
No, I would say I foresee that as being maintained, because it's not just, I mean, it is partly about the wildfires, and as Alex mentioned, the rivers, the flooding, just extreme climate events, which again, I think that unfortunately we now live in a world where those are just more likely. But also because of the huge explosion in the volume of surplus lines business being written in this market and also in the US. I think is garnering increased attention from regulators. And so these kinds of market conduct tools that maybe historically have been more focused on admitted insurers, we are starting to see more attention from regulators, with respect to this market. And I think, you know, the fact that the NAIC has added market conduct to their bailiwick now with respect to alien surplus lines insurers is another example of that. And we see there looks like there is a Q&A.
So actually just a positive comment that's come through on the Q&A for you both, because I know that's I think the only way for people to get in touch. The chat isn't generally open. So thank you very much for passing on that comment. And what we will do is just give everyone back 10 minutes. I think it makes sense to do so, but of course encourage you to get in touch with Andrea and Alex if you do have specific questions that follow the session. So we will, as I mentioned, send on the slides and the recording of the session probably in about a week's time, and then we will work on the certificates. I think it looked as though we had about 140 people on the session, so bear with us because it will take a bit of time to get those set up and ready to be sent. As I said before, if you have any questions, please do reach out to the IUA's events manager when we talk about the administrative perspective for the event, and that's Deborah Finch at IUA, Deborah.Finch, I should say, at iua.co.uk. And it's also worth noting that we will be holding a second California Fair Claims Handling session a little bit later this year. So we tend to provide two each year, one around this time and one a little bit later on. So that is at the moment scheduled to be on the 8th of October, if you have any colleagues who might be interested in attending. But of course, we will finalise the details and share an invitation much closer to the time. And I think with that, I'll just check, Andrea and Alex, if there was anything more that you wanted to add.
Not from me.
Nope, nothing here. Appreciate everyone logging in and listening to us.
Yes, exactly.
Yeah. Absolutely. Yeah, well, thank you both. And thanks very much to everyone who took the time to join, and wishing you an enjoyable rest of the afternoon. I'm sure we will see everyone at some point soon.
Okay, great. Thanks, everyone.